Welcome to Return My Capital. Today we're going to take a look at a company that through a recent announcement is certainly focused on returning capital to shareholders, primarily via share buybacks and dividend payouts. So I'm going to go ahead and share a screen here. Let's see if he can do it. Oh, he's done it. Okay. Colgate-Palmolive is the company, ticker symbol CL. Looking at a couple of basic charts here, one day, who cares? Over the past month, about even, 2.5% up. Over the past 6 months, it's been getting beat up a little bit with the rest of the market, down almost 13%. Over the past year, about even. You see, year ago, trading around $89, now $90. Over the past 5-year and 10-year charts, though, you'll see nice trend, consistent, slow uptrend, as you would expect from a company of this maturity, if you will. So 5-year chart up nearly 50%, 10-year chart 31%. So from a pure price appreciation perspective, this is kind of what you would come to expect from this type of company. We'll get into some of the metrics here in terms of growth expectations shortly. Trading in the 52-week range, near the lower end, that being 85, high end 109. Forward price to earnings ratio on Colgate-Palmolive here is a 24. And as you'll see with the growth metrics, it's actually a pretty elevated price to earnings ratio, especially on a forward basis for a company growing as slow as this one is. But that may not be the reason why you would add a company like Colgate-Palmolive to your portfolio. Dividend rate, $2 per share per year. So nice 50-cent quarterly dividend payout here. 2.2% dividend yield. So not a very high yielding dividend stock. We'll take a look at the dividend metrics, but certainly higher dividend than if you were purchasing something like a VTI or a VU, a broad market ETF. You are getting about double that dividend payout as you would with a more broadly diversified ETF, index fund, whatever the case. Really no short interest to speak of here, 1.3%, $73 billion market cap company. So certainly a company that is included in the S&P 500 with a market cap like that. Now, the recent announcement, reason I'm making this video, Colgate-Palmolive did announce a nice 4% dividend increase, bumping that 50-cent quarterly dividend from 50 cents per quarter up to 52 cents per quarter. So an additional 8 cents per share per year, 4% increase on the dividend. Also, really the most attractive bit of news in the recent announcement was the share buyback program. You'll see here, just from this headline, $5 billion share buyback program. And truthfully, it's an extension of an existing same $5 billion share buyback program. If you click into the press release, you'll see that it's an extension, right? So if we scroll down to the actual share repurchase here, it's an extension of the existing program. Now, I quickly did the math. And if you take a look at the 812 million shares outstanding, a $5 billion share buyback, and that is a $90 per share price. So if we take a look at the market cap, $73 billion, and they just announced a $5 billion share buyback program. So if we pull up a calculator here and do a quick 5 divided by 73, it's actually a pretty attractive 6, almost 7% of the float buyback. So you add in that 6-7% share buyback, you add in the 2% yield on the dividend, couple percent a year, and that's why a company like Colgate-Palmolive can be an attractive investment over the long term. Take a look at a few metrics here. Analyst ratings, predominantly positive between buy and strong buy. You're looking at 13 of the 23 Wall Street analysts covering, 8 with a hold rating and 1 sell and strong sell, respectively. Primary driver of having a hold rating on a company like this is just the fairly stagnant growth. You look at revenue year over year, going back to 2020, coming in, what is that? 16.5 billion, expected to be 21 billion end of 2026. So yes, nice consistent grower. It's the type of company that makes products that can routinely raise prices on products over the course of time. Call it an inflation adjustment if you want, but a lot of consumer staple type products here. You'll see the non-GAAP EPS quarterly over the past couple quarters, fairly stagnant. Earnings estimates, looking at 3, 8, and 8 expectations for EPS growth over the next 3 years. Sales expected for 2025 are 20 billion. Looking out into 2027, you're looking at nearly 22 billion. So looking at the price to earnings expectations for 25, currently sitting at 24, and then you'll see that slowly start to come down, getting into 2027, nearly 21 price to earnings expectation based off of those earnings estimates. You'll see sales are trailing the expectations of your EPS guidance there, and you can attribute that to the fairly rapid share repurchase program that they have in place. You'll see here the prior 3-year revenue CAGR of almost 5%, some valuation metrics there. Again, in terms of momentum, trading near the bottom of the 52-week range, so certainly below its 200-day moving average. Profitability, very solid profitability margins, especially for a company in this type of industry. It's not a tech stock, obviously. It's making consumer staples, so pretty solid margins for the type of product it makes. The balance sheet, so again, 73 billion market cap company. They hold $8.5 billion of debt with 1.2, say 1.3 billion in cash. So it's not going to be a mega cap tech balance sheet where they could pay off all of their debt with a quarter's worth of earnings if they wanted to, but certainly not the worst balance sheet you're going to see with this type of business. Now, I say this type of business because they've been paying a dividend for 61 years, 61 consecutive years, I should say. So certainly a dividend king. Payout ratio, 55%. So still quite healthy for, again, this type of business, this type of company. They've been growing it at about 3% on the 5-year CAGR here. So not a high dividend growth, but very stable, very consistent. And when you've been paying it for 61 consecutive and increasing years, it's actually pretty impressive that the payout ratio isn't above 60%. So again, current forward payout is $2. Just got announced that it will increase to $2.08 per year with that, what was a 4% increase that they just announced. So that yield will increase slightly as well. You can see the dividend growth history over time here. If we look back 10 years ago in 2014, they were paying out an annual dividend of $1.42. Now to 2024, it was just under $2. Now it will be $2.08. And just quickly looking at the ownership structure of Colgate-Palmolive, very heavily owned by institutions at 86% of shares outstanding. Again, not unexpected for a business that is this mature and has been a consistent performer for as many decades as it has been. You can take a look at a couple of the peers. Really, the only ones that stand out to me or that I recognize, the US-based companies of Kimberly-Clark and Church & Dwight. I think Church & Dwight makes Arm & Hammer, if I'm not mistaken, and Kimberly-Clark, you've probably seen them on paper products, toilet paper, paper towel, whatever the case is. But those are the type of businesses that would be comparable to Colgate-Palmolive. So just wanted to take a couple minutes here to quickly run through some growth expectations, some information on the dividend, as well as the stock buyback that was just announced. Always nice to get those announcements, especially on a company like Colgate-Palmolive, that if you are holding them, that's what you've come to expect. You're not expecting 10, 12% year-over-year returns in share price appreciation. So really, the dividend, the consistency, the stability, I'm sure this has a lower beta than the overall market. And it's just a steady, slow growth player. The share buyback, a key part of that. So thank you for watching. I hope you got a little bit of entertainment, a little bit of information out of this. Yeah, thanks for watching and speak again soon.